Good evening, investors. Welcome to the last episode of Understanding DGOC, part 5. This time we're going to look at the outlook, the thesis, and I'm going to show you the final valuation. Let's start with the outlook. So, this is the outlook that the DGOC posts on their earnings report. So, it starts with focus on margin enhancing growth and efficiencies. Second, opportunistically hedge to protect cash flows. And last, strengthen balance sheet for financial flexibility. In the previous videos we have already looked at this, so what this basically means is that whatever they have been doing in the past 3 years, they're gonna do the same and they're gonna do more of that. So they're just gonna improve, they're gonna grow, just all the same things. If you look at a video, any video of the CEO being interviewed, there are plenty of them on YouTube. I think Active Investors is interviewing him on a regular basis. Every time he gets the question, so what can investors expect from DGOC in the near future? And each time, and you can check several videos, I promise, each time the CEO says more of the same, more of the same. Extremely boring. It's not going to be your next Amazon or your Microsoft or your Netflix is going to come up with a great idea. Yes, and that's how we're going to break the market or whatever they would refer to, but more of the same because whatever they're doing right now is creating a massive amount of cash flow. So that is the outlook. So this one you may remember from my first video, the one with the very soft voice. This is basically what I suggested based on the current price and whatever they were doing right now. I was already thinking that it was undervalued on the current price, taking no growth into consideration, and I basically determined these prices on the price to free cash flow. So here, below 90, you pay approximately price to free cash flow of 3, which is, in my opinion, undervalued. Then this range from 90 to 130 is price to free cash flow of 4. Keep in mind what this means is when you invest money in this company, you're expected to regain whatever you invested in it in this case 4 years. So that will be a 25% annual return, not completely, but let's just keep it like that. So it's already a very generous opportunity. Fair value, I would say it's around 6-ish. To be on the safe side, you could be 5, 6, and if you go higher than that, it's going to be a bit overvalued. Again, this is assuming no growth. So if it's a price to free cash flow of 8, it means that you're going to get 10 to 12.5% return on average on your investment if you take into account no growth. So it is not a bad investment. You would still beat the market, but in this range, if they are not growing and the sector you're in, the industry, gas, oil, I would suggest to sell it. However, this company, as we've seen in my previous videos, has a very strong business model and therefore a very, a very amazing potential to grow. And that is what I've been looking at lately. And to my surprise, I was actually able to get a pretty decent valuation out there. So I'm kind of curious what you guys will think about that. So make sure to let me know in the comments. So what you see here is the acquisitions that they have made since February 2017. And they mention in 2018 and 2019 they have made their biggest purchases, and what you see is the purchase price and the production that it offers. And here again, production price and the production that it offers. So what I did, I wanted to know how much money they have to spend, purchase price, in order to get 1 MBOEPD meaning 1 million barrels of oil equivalent per day. I want to know that, so I divided the purchase price by the production, and then I knew how much money they had to spend to get 1 million barrels of oil equivalent production per day. So top one, 15.14 million to get that production, and 2081 was 15.38 to get it. So what we know now is that if they have this money available and they buy an acquisition, it is probably going to be around the range to get this production. And if we calculate how much their production is going to give them revenue, and if we're going to calculate how much revenue in general will end up with profit, let's put it like that, then we know how much money they're going to make in the near future if they are going to acquire more companies. So let's look at some more details. Alright, so don't get overwhelmed right now. We're going to go through everything. I tried to go through it slowly. I want to explain this very well because I think it's very important. So first one, total MBOE. This is basically their total production. So you see it in the first quarter they had this production, second quarter they had this production, third quarter, fourth quarter, and their total for 2019 is this production. So you see a nice steady increase. It slows down a little bit because they haven't done any acquisitions or no noteworthy acquisitions in this period. So they're basically just putting new wells or existing wells into production again. Still increasing production, which is great, but no, let's say 1500 approximately growth in one quarter. So here at the bottom you see their daily production, and you see how that increases as well. And on average they have this daily production. Then on this row I put the revenue. So here you see per quarter the revenue with their total revenue right here. And here I put the adjusted EBITDA, which is basically the number that they use to calculate their leverage ratio. So we're going to come to that in a bit. So 273 adjusted EBITDA. So what I wanted to know, based on if they add one more production here per day, how much revenue would that generate? So the number we saw in the previous slide is important for this one. So we want to know how much revenue will be generated if they increase production by 1 million. So if they spend, let's say, $15.5 million, how much would the revenue increase? And it would increase with 5.45 million basically. But we also want to know what it does to the EBITDA, because once we know what it does to the EBITDA, we can then calculate the impact on the leverage ratio. So to check this rate or ratio to see how much of the EBITDA is going to be available, we can then calculate how much revenue or how much EBITDA is going to be generated per 1 million of barrel of oil equivalent per day production, and that is going to be 3.22 million. Could have also done basically this number dividing by this number, as you may notice, but I wanted to be thorough and I just wanted to check this as well. So on to the next table. Here you see the available liquidity. This is basically the amount of money that they can still borrow from the banks. So we want to know how much is this liquidity, how much potential production does that offer? And it offers, let's go to this one first as well. Like we've already seen this number in the previous sheet, amount of debt required per 1 million barrel of oil equivalent per day. And that requires 15.5, I rounded it up to the top to be on the safe side, $15.5 million to get that 1 million production. So if we use this number and divide this number by it, we get the amount of production increase that we can expect with the available liquidity. So here you see the available liquidity. Here you see the increase, sorry, of that is expected in 2020 if they use their liquidity. Is this on the safe side? I believe so. Why? Because they are still paying off debt. So they are expected to pay off what? Like another 100 million. So if they acquire in the third quarter this year, they could acquire more than this. And if they acquire more than this, that means that the production increase could be more as well. But we're going to be on the safe side, just on just use the numbers that are available, and we are going to calculate what is the outcome. So here you see this number, 13.74. So now we know how much potential production increase they can generate, and we wrote the EBITDA per 1 million here, the one that we calculated here. And if we multiply these numbers, then we can assume, or we can get an idea of how much their EBITDA will increase over the full fiscal year of 2020. We know the EBITDA of this year. So here we see that with this liquidity, they can increase their EBITDA by 16.2%. In my opinion, this is still on the safe side. I think their production is going to grow quicker. And why is that? Because they have shown in their sheets that they want to fund acquisitions with 50% equity and 50% liquidity. This is the liquidity part. That means that they are going to use equity of a similar level if they're going to stick to that plan. I'm not entirely sure if they're going to stick to that forever, because it was in a previous sheet like a year ago that I read that. So I'm not entirely sure. But assuming that they are going to also use the equity side. How are they going to generate equity? They're going to increase, or they're going to generate it by share dilution. I don't think that's that favorable, but because it's going to dilute your shares, so your shares are going to be worth less because they need to generate money by putting out more shares. But to just use the liquidity, or the debt in this case, for the calculation, we are at least on the safe side, and we do not take the dilution into account, but we also don't take into account the growth that the dilution could cause. So this is just an extremely safe bet, and in the complete valuation, it is to keep in mind that I am expecting these numbers with the current amount of outstanding shares. If they increase, they might get lower, but if they increase, they are also going to increase production. So I still think that this is going to be more or less the same then, only the numbers is going to be different because there's going to be more shares outstanding. So keep that in mind. So on to the final table. The expected debt. What I did here is basically the available liquidity. I added it to the current amount of debt, and then you have 725. Then I put down the expected EBITDA, and I divided these numbers, and that is how we calculated the leverage ratio, as we could see in the financial model video, part 2. So if you haven't checked that out, make sure to go to the second video and check that video because of the leverage ratio, because that is basically how I'm using, how I'm estimating this growth. And if you remember the picture, it was that they wanted the leverage ratio between 2 and 2.5. If this model is going to be correct, the leverage ratio is going to stay at 2.3, which is where it is now. So it is a pretty safe model. It could go even further, but they're going to need to use more liquidity for that. And we are not certain about that, so I'm going to be on the safe side again, and we're going to stick to this. So I hope this sheet is understandable with my explanation. If you have any questions, please let me know in the comments below. I know this is probably a very boring part for most of you guys, but this is actually the more exciting part for me, because I like to be busy with all these kind of calculations. So just make sure you ask me the questions, and I'll be sure to answer them. So the fair value calculation. This is where it all comes down to. and this is probably what you've all been waiting for. Data used for fair values in millions. These are all my estimates. So I'm going to walk you through it first. Price to free cash flow assumption is 5. I believe this to be fair value. Is it correct? No, I think it is still on the defensive side. If you check Shell right now, I think Shell is trading at a higher level than this, and it is dropped like 50%. And yeah, I don't think this is that crazy to have this amount, but this is just something that I want. I think this is safe. It is still an industry that is not very attractive. It is a small cap. We cannot expect too much, and in 10 years we still want to get around 15 to 20% return from our investment. So at this price to free cash flow ratio, we are going to have that. So I have this as an assumption. Compound annual growth rate, I put that on a 15%. Is that correct? No, I calculated around 16%, but again, I want to be more on the safe side. I could be wrong in my estimates. They could not acquire that company. They could use more debt. They could use more equity. It could be disappointing growth. Who knows? There are many options there, so I want to be on the safe side. Discount rate. This is always an assumption. Normally, I would put here the number that I want, like the percentage that I want as a rate of return from my investment, so that I know that, let's say, I want to have a 15% rate of return. I am going to discount it with 15% so I can estimate the fair value. But right now, the price that I want to pay for it, regardless of the fair value. Sorry, I didn't say that quite correctly. But right now, I just want to calculate the fair value regardless of my rate of return. So I'm going to use a 5% discount rate, which is basically, let's say, the money that loses value, and a little bit of opportunity cost, because obviously this is higher than inflation. But yeah, there's also an assumption, so anybody else could just use a different number. Free cash flow of 2019 came down to this number, 246 million, and these are the outstanding shares. So on to the fair value calculation. The expected free cash flow for fiscal year 2029. This is how I calculated it. So I grabbed the free cash flow of 2019. I added the compound annual growth rate, which I put here, and I did that. I forgot the English word for this, sorry. Not times, but I did that to the 10th, basically. And I came down to this number. But that's it. This is basically what, with this growth rate, what I expect them to have as a free cash flow 10 years from now. But how much is that expected free cash flow worth today? So I used the discount rate to calculate how much that free cash flow is worth today. And that free cash flow would be worth this amount today, because the money loses value. On to the expected fair value. What I did here is I used this number that I think that is going to be fair value in the future, and I multiplied that by the expected free cash flow of 2029, this number. So I did this number times this number, and that came down to almost $5 billion US. So if I discount that number, or I use this number and do it times 5, I come down to basically 3 billion. Then I want to know how much money that is per share, because we need to pay a price for that share. Or we want to know, we're always going to think in shares in regards of investments. So I used that amount, the discounted free cash flow that you see here, this number. I divided that by the outstanding shares to get the price per share. Obviously, the company is using US dollars, and it is trading on the London Stock Exchange, so we have to discount that to British pounds. Obviously, there's a big risk here because of the currency risk. We don't know how it's going to be, but this the pound in general is very favorable, like it's trading favorable for the buyers in US dollars or in euros. So this is not that unsafe in my opinion to use this calculation. And if we put this number and we do it to the British pounds, the British pence, sorry, we get this number, so 410. So what this number means is that this is the fair value of the current stock price if you take this growth into account. The growth of 15% and you take it of a 10-year period. This is basically what always happens with all the growth stocks. You price in the growth. In an oil and gas company, you're not going to find any growth priced in. That is also why it is undervalued. But they have shown an amazing amount of growth. It could be that this company catches on, and if they reaches the growth, if they reach the amount of investors, let's say if they're going to trade on the main market, then this is not that crazy of a number to be looking at. But again, this is the discounted amount. So this is basically if the share price would be worth 410 pence today, if it doesn't grow that much, I'm saying this poorly, sorry. What I mean by this is the share price of the expected share price of 2029, which is almost 670 pence, is worth today 410. So I expect it, based on the assumptions and the calculations above, I expect in 10 years this company price to be this number with this amount of shares. So when I started making this video, DGOC was trading at 60. That means that this would be an over 11 times your investment increase. That is basically a 10 bagger. If you know what it is, make sure to check out, make sure to Google that, because it is from Peter Lynch, I believe, and it's very interesting. So this investment is going to be very good. Again, this is the growth thesis. So I showed you before the defensive thesis, assuming no growth and just use it as dividends. This is the growth thesis. Something important to add, this is a growth thesis without including the dividends. If you include 10 years of dividends, you can add, I think, about, if you bought at 60 and if you take this growth rate and the dividend is going to growth, like I'm guessing right now, but I am, let me do it right now out of my head real quick. So growth rate of 15%, they have 0.14. That would mean that it is gonna double twice. Poof, that's gonna be if you take the dividends with this, I think you're gonna have at least 15 times your investment back. But again, this is the growth thesis. In a growth thesis, I really do not take into account the dividends. I think, but right now I'm just looking at share price and what I think is going to be worth. Maybe in the future I will take the dividends into account. So that's basically my fair value calculations on the growth thesis. You can either see this as a defensive investment, and you go for my previous thesis and you're going to sell at 250, and that is going to basically that would be an expected thesis for the oil and gas industry. If you take into account my growth thesis, and this is the reason why I am investing in it, then this is something that you can expect. So I suggest, if you think that I am going to be somewhat correct, like let's say I'm not correct, let's say I'm half wrong, like take half off the number, it's going to be like what, 335? That's still 4 times your money, not including the dividends. And even if you take half off of that, okay, that's going to be pretty less. It's not going to be a great investment, but it's not going to be a bad one either, because you're still going to get a 40% return plus 10% dividend every year of 15 or whatever price you bought it at. But you need to make sure that you know why you're investing in it. Whatever thesis you pick, it's not going to be right or wrong, but you need to know it up front, because you need to know when you're going to sell. It's also good if you're not going to sell, but you need to know that up front, because otherwise you're basically not investing, you're just having fun, I guess, because it's not even speculating either. So make sure that you look at both my theses, make a decision, go somewhere in between, but make something of your own, and make sure that you stick to it. That is also very important. Alright guys, that rounds up the final part of understanding DGOC. I hope you guys enjoyed the valuation, and above all, that you learned something. If you did, please leave a like, and if you didn't, feel free to let me know in the comments, because I would love to improve these kind of videos for you. Thank you for watching, and have a nice day.